Thomas, maybe you can tell us a simple question. How do we make money?
That's a good question, because we get that asked all the time. So how do you make money in real estate? Really, real estate has been around for several hundred years. If you have been to Rome, perhaps you've seen that buildings there are 2,000, 3,000 years old in Egypt. So buildings have been around for a long, long time. And someone has to own these buildings, and it occurred to me really relatively late in my life actually that it could be me, or a group of investors could own this building. So you make money by renting space in your building. So one source of your income is the income it generates, usually on a monthly basis, because you have suites for rent and people pay money every month. So it's like a three-course meal. So the appetizer of a three-course meal is the cash flow from the building. It's desired and it's appreciated, but it's not necessary. The positive cash flow. Certainly we want to have that. The second thing, which is really important, is that as you own a building, you have usually a mortgage on the building, because you don't usually pay all cash for the building. You can, but then the return on your money is relatively low, very low. So we usually have a mortgage between 60 and 80% on the building, and we pay that mortgage down every month. So if you hold a building for perhaps 20 years, 25 years even, the mortgage is paid to zero. And then you own a building free and clear. So that's really the main course of the three-course meal, that you pay your mortgage down every month. You make money, you make equity every month in your building. And the third part, which I liken to the dessert in a three-course meal, which is also always appreciated but not necessary, is the equity appreciation. Usually, not necessarily every year, but on average, perhaps over a 10-year period, rents go up. Usually by inflation, more or less 3, 4, 5%. In stronger markets like Alberta, Saskatchewan, a bit more than that. Or in buildings we own, and that's what we call the company Precious Properties. We invest in the building, and therefore the building is a better building 3, 4 years from now than it was when we purchased it. The rent is higher, and if the rent is higher, the value is higher. So we have a combination now of cash flow, positive cash flow, which often gets reinvested in the building. We have mortgage pay down, and we have equity appreciation. So those three elements, like a three-course meal, make up the return on your investment. And I might even want to add a fourth portion, perhaps, which is tax deferral or tax preferential treatment of your investment, in that much of the income of the building is tax preferred. And you can lower your taxes for a few years as well. So, but the three key elements are cash flow, mortgage pay down, and value appreciation, and the combination of that can be very, very powerful, yielding probably about 10, maybe 12%, which is our target return on these investments.